Hey everyone, welcome back to Corporate Decoder. Today, E.T.F.I.S Series Trust I just filed its semi-annual shareholder report, and I am seeing some interesting numbers in their financial tables. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek into how several different ETFs, or exchange-traded funds, are doing and where their money is invested, with some key stats as of April 2026. This trust actually holds a bunch of different ETFs, and this report gives us the financial details for several of them. We are going to focus on the financials from these tables to see how things are shaping up. First up, let's look at the InfraCap REIT Preferred ETF. As of April 2026, its fund net assets were about $118 million, holding 111 different investments and a portfolio turnover rate of just 3%. This suggests a pretty stable, long-term approach to their holdings. Their asset allocation shows a big chunk, 62.9% is in real estate, with 36.3% in financials, and a small 0.8% in money market funds. This makes sense given the REIT name focusing heavily on properties. Next, let's check out the Virtus InfraCap US Preferred Stock ETF. This one has much larger fund net assets, almost $2.35 billion, with 199 portfolio holdings and a significant 24% portfolio turnover rate. That turnover rate indicates they are more actively managing this portfolio compared to the REIT Preferred ETF. Their asset allocation is heavily weighted towards financials at 52.7%, followed by real estate at 17.1%. They also have exposure to industrials, communication services, utilities, and information technology, showing a more diversified approach than the REIT fund. Now, for something very different, the Virtus Biotech Clinical Trials ETF. This fund has just over $37 million in net assets, holds 125 positions, and has a portfolio turnover rate of 38%. This higher turnover suggests a more dynamic strategy likely centered around the fast-paced biotech sector. As you might guess, their asset allocation is almost entirely in healthcare at 97.8%, with just 2.2% in money market funds for liquidity. Closely related is the Virtus Biotech ETF. This ETF holds about $59 million in net assets with 63 portfolio holdings and a 17% turnover rate. Still in the biotech space, but with fewer holdings than the clinical trials ETF, possibly indicating a more concentrated portfolio. Unsurprisingly, this fund is also heavily concentrated in healthcare at 96.9%, with 3.1% in money market funds. Moving on to fixed income. The Virtus New Fleet Multi-Sector Bond ETF has substantial fund net assets of over $424 million, holding a large number of positions, 1030, and a portfolio turnover rate of 27%. This suggests active management within the bond market. Their asset allocation is quite spread out across different bond types. Corporate bonds make up 29%, foreign bonds are 24.2%, mortgage-backed securities are 22.8%, asset-backed securities at 9.3%, term loans at 8%, and US government securities at 5.5%. They also hold a small amount in ETFs and preferred stocks. Let's look at the Virtus Private Credit Strategy ETF. It has about $33 million in net assets, holds 59 positions, and has a 16% turnover rate. This fund is focused on private credit, which can be a bit more opaque than public markets. Their asset allocation is interesting, with 48.6% in financials, a large 33.5% in closed-end funds, and 17.9% in money market funds for cash, indicating a strategy that leverages other investment vehicles to gain exposure. The Virtus Real Asset Income ETF has around $18 million in net assets, 92 holdings, and a relatively high portfolio turnover rate of 57%. This high turnover suggests they are actively trading in response to real asset market conditions. Their asset allocation is concentrated in energy at 33.6% and real estate at 32.1%, with utilities making up 17.1%. This mix points towards investments tied to infrastructure and tangible assets that can generate income. Finally, the InfraCap MLP ETF. This fund has a significant $463 million in net assets, holding only 30 positions, but with a considerable 44% portfolio turnover rate. As the name suggests, this is all about MLPs, which are a specific type of partnership often found in the energy pipeline sector. Their asset allocation is overwhelmingly in energy at 98.8%, with a small allocation to money market funds and a tiny bit in utilities. This concentration in energy MLPs carries specific risks related to that sector's volatility. Now, let's dive deeper into the financial tables for a couple of these funds to get a sense of their performance. For the InfraCap REIT Preferred ETF, Looking at the period ending the 30th of April 2026, their investment income from dividends was a strong $2.96 million. This shows the income generating potential from their REIT holdings. Expenses were around $242,000, leading to a net investment income of over $2.7 million for the period. The net realized gain on investments added another $367,000, contributing positively to their net assets. The Virtus InfraCap US Preferred Stock ETF, a much larger fund, had impressive dividend income of nearly $80 million for the same 6-month period. However, their expenses were also significantly higher at over $8.3 million, largely due to high interest expenses of about $12.5 million related to their borrowings. Despite this, their net realized gains and positive unrealized appreciation led to a significant increase in net assets from operations. Turning to the InfraCap MLP ETF, their investment income is dominated by distributions from MLPs totaling over $10 million. However, they also incurred substantial interest expenses of nearly $2.4 million, which is common for funds that use leverage. Their net realized gains were over $7.2 million, and a significant unrealized appreciation of over $115 million contributed to a massive increase in net assets from operations for the period. This volatility in MLPs can lead to large swings. These financials paint a picture of diverse strategies across the E.T.F.I.S Series Trust I. Some funds are focused and stable. Others are actively managed for income or growth, and some, like the MLP and biotech funds, carry sector-specific risks and higher volatility. The preferred stock and REIT funds appear to be income-focused, while the biotech funds are clearly positioned for growth in a highly speculative sector. The bond fund offers broad diversification across fixed income, while the private credit and real asset funds explore more niche areas. What I am watching for is how these different strategies will perform in varying economic conditions, especially for the more leveraged or concentrated funds. The use of leverage in the InfraCap MLP ETF is a double-edged sword, amplifying gains but also losses. The heavy concentration in biotech also means that if that sector faces headwinds, those funds could see significant declines. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.